This is the third section on bonds, and this is yield to maturity. Yield to maturity is essentially the return you get if you buy a bond today and hold it until it matures. And I'm briefly going to talk about factors that determine the yield to maturity. So in other words, what determines the size of the return you ask for when you buy a bond. So goals for this unit are to understand the yield to maturity, define interest rate risk, understand default risk, talk about liquidity risk, and sort of see how these three combine to give you yield to maturity. And then of course we're going to do some calculations. I tried to give you fairly detailed notes on this unit, so feel free to hit pause and read through them at your convenience, and I'll do a brief summary on some of the slides. Bonds yield to maturity is determined by interest rate risk, maturity risk, and default risk. Interest rate risk is sometimes called maturity risk. It's sometimes called time risk. It's just the risk you experience from holding a bond until it matures. And the way it works, the longer the time I plan on holding the bond, the more risk I face. And interest rate risk is risk that is due to changes in the economy. It could be inflation, it could be unemployment, it could be changes in the way our economy is functioning. It could be things like the mortgage crisis of 4 or 5 years ago that put a lot of risk into our bond markets. So the point is, the longer away maturity is, the greater exposure my bond coupon payments have to changes in the economic environment. So as a rule of thumb, the longer the time until maturity, the greater the compensation I want for holding the bond. And of course, when market rates change, bond prices change, and that's why we were a little nervous for longer maturities versus shorter maturities. Default risk is the chance that the borrower who was paying my coupon or interest payments can no longer pay them. In other words, they go bankrupt or have to reorganize. It's a chance I don't receive my cash flows from investing in the bond. Now there's ways to estimate this before you buy a bond. There's credit agencies such as S&P, which stands for Standard & Poor, and Moody's rate and evaluate the credit worthiness, excuse me, that's my cell phone, hope you didn't hear that, of firms that are traded in the open market. And really the grades they assign are a lot like grades you get in a class. If you're A-rated, you're solid credit. So it starts at AAA, AA, A, then it goes into the Bs, triple B, double B, B, and into the Cs. Anything rated triple B or above is considered investment grade and somewhat a safe investment. Of course, the higher the grade, the safer the investment. Now, credit ratings are based on a lot of factors. They won't tell you a formula for it, but essentially it's how solid are your financials, what does your future look like, what's the state of the competition in your industry, and are there things like outstanding lawsuits or OSHA or economic factors that are starting to face your firm. Liquidity risk is the ease at which a bond can be sold and converted to cash. So in other words, if I'm not happy with the investment, can I get rid of it? So an investment is considered liquid if I can easily trade it. Now things such as government bonds are very liquid. There's a market for them all the time. You can buy and sell them with relative ease. Corporate bonds and municipal bonds are not always very liquid, and it's not always easy to get out of those investments. So of course, the less liquidity an investment has, the more compensation or the greater the return I want as an investor, because I don't want to get stuck holding a bad or dangerous investment. If you put all these together, investors want a compensation for the risk they face. So the greater the time until maturity, the greater the return investor wants for interest rate risk. The poorer the credit standing of a firm, the greater the return I want for buying their debt. The more difficult it is to trade a firm's debt, the greater the compensation I want for holding it. So when you put these factors together, you can sort of add them up. I mean, we're simplifying this obviously, but when you add them up, this gives the total return I want for a bond. And what I want you to see here is no two investments are alike. Now that first term is where I have R and then OPP underneath it. That's opportunity cost. That's just the return someone wants for putting their money in debt to begin with. It's sort of like a risk-free return, if you will. And the second or final thing I want you to take from this is the yield to maturity changes over time. It changes when the economy changes. It changes when the state of the firm or the success of the firm changes. So recognize it's a dynamic thing. To solve for the yield to maturity essentially is, if I pay a price for a bond, what return do I get, assuming I get these cash flows? So in other words, what return or what interest rate, when I discount the bond coupons and face value, makes them add up to the price I pay? As you see the formula below, YTM stands for yield to maturity, and it's an interest rate. So here's an example. So suppose we want to buy a treasury bond with face value of $1,000 and coupon rate of 6% paid annually with 3 years remaining. The broker tells you we can buy the bond for $973.76. What's the bond's yield to maturity? Notice I don't speak anything about what's happened prior to today. The yield to maturity is simply the return I get for the time remaining on the bond. We have 3 years, so I would get 3 coupons here at 6%, and we get the face value at the end of $1,000. So I simply set the price equal to the bond pricing formula, where the yield to maturity is the interest rate. Now solving this by hand is pretty much impossible, so we're going to let a financial calculator do the work for us. In the financial calculator, N is 3. That's the number of coupons until maturity. We put the price in as a negative. This is critical. We're thinking about cash flow here. The price is a cash outflow. All right? It's money I invest to receive these bond coupons and face value. I compute the yield to maturity. Now, payment's 60, excuse me, because that's 6% coupon gives you a $60 payment for the next 3 years. Face value is $1,000. I solve for yield to maturity, I get 7%. That means that if I buy the bond today at the current price, I will get a 7% annual return on this investment. See if you can verify this result. Now let's look at semi-annual. Semi-annual is the same idea as when we were pricing bonds with semi-annual coupons. When we solve for this interest rate, the key here is this is going to be the 6-month return on the bond. We're solving for an interest rate across 6 months. That's not a yield to maturity. When we solve for yield to maturity on a yearly basis, we need to annualize this solution we get. And let's run through this. So we got the same setup here, same facts, except we now have a 6% annual coupon rate with semi-annual coupon payments. So now that $60 is split into 2 equal $30 payments every 6 months. Now, instead of just 3 years, our N is going to be an N prime, where we're going to have 6 payments until the bond matures. Let's look at the answer. So if we set up our equation, notice now that the coupon's cut in half. The number of periods is doubled since we pay twice a year. Everything else looks the same. Plug into our financial calculator. We get a 6-month return of 3.49%. I'd like to annualize this. Typically we use this as an EAR. Remember what an EAR was? It's what's the effective annual rate. So if I'm getting 3.49% every 6 months, to find out the annual rate, I say 1 plus the 3.49%, I square it and subtract 1. So 7.11% is our effective yearly return on this bond. And of course, I included the Excel work in case you're interested. There's other yields to consider here. Current yield is a return that we express for short-term investors. It's a 1-year return, and we assume the price of the bond does not change. It's a simple calculation. You just take the annual coupon. Now this is whether it's semi-annual or annual. You just total the amount of coupons you get for 1 year, and you divide by the current traded price. The formula is below. Another return is called yield to call. Now sometimes bonds are issued with what we call call options. And that's just a provision in the covenant that allows the company to retire their bonds early or call them in. Now think about it. Why would a firm call in their bonds? Think about this for a second. Well, a firm's going to call in their bonds really for 2 reasons. One, if they could turn around and reissue new bonds in their place at a lower coupon rate. And why would they do that? Well, because it's less money they're paying for interest. Your parents probably refinanced their house when interest rates have been so low in the last few years. That's a prime example of calling in a bond, like calling in the mortgage, and putting a new mortgage in its place. Second reason a firm might call in their bonds is they might just want to retire the debt on their books. A lot of folks and a lot of businesses don't like to be in debt. Now the yield to call is we just assume the firm will call in their bonds on the first possible date, and the covenant typically says they can't call in the bonds before date XYZ. So when we do yield to call, we assume that the firm will act on this the very first day they can do it. So yield to call is the return up until that date. So it's the same idea as yield to maturity, except the date we use is the first possible call date. And this concludes bonds.